The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. Today, I'd like to cover a wide range of issues from employment, and specifically employment in the Lehigh Valley, to wages and wage rates, the outlook for construction, materials prices, consumers, and the financial condition that they're in, inflation, and interest rates. So let's start out by jumping into employment. Nationally, the unemployment rate stands at about 3.5%. Here in the Lehigh Valley, it's 3.7%. And when we look at construction, the unemployment rate, largely because of seasonal factors, sits at about 7%. And you could see the number of unemployment claims has been gradually declining over time. When we look specifically at the Lehigh Valley, we have a population here of just under 700,000 people. We have 366,000 or so participating in the labor force, and a median household income of about $78,000 a year. Now that translates to a median hourly wage per worker of $21.50 an hour, or about $43,000 a year. Again, that's a median across the Lehigh Valley. When we look at the unemployment rate and wages, in particular, what kind of pay raises, a lot of people are asking, what kind of pay raises are employees receiving right now? And the rate of year-over-year increase as inflation has come down has been coming down, but it still stands close to 5% at 4.8% right now. So that's kind of the rate of increase that many employees are expecting, is 4 to 5% in terms of doing those annual reviews and looking at reevaluating wage rates for the upcoming year. The Architectural Billing Index, while it's improved a little bit from where it had been, again, it's still demonstrating weakness, particularly in the Northeast. So, of course, projects are designed before they're built, and in the Northeast, a reading on the Architectural Billing Index of 50 or greater means that we're seeing expansion in the number of new projects that are being designed. Well, right now that sits at 43.6. A little better than it had been, but still demonstrating contraction in construction. At the same time, construction sentiment continues to look okay. When we look at the amount of backlog that companies have, and when we look at companies' expectations for sales, profit margins, they continue to hold up pretty well. A little bit of a mixed bag, but generally still looking okay, particularly here in the Lehigh Valley. Materials prices are all over the place, and I thought it might be helpful to zoom out a bit. We've been showing a one-year chart here, which shows that while lumber prices are still coming down, asphalt, paving mixes, and concrete are increasing pretty dramatically, especially just over the last month or so. But when we zoom out and we look across a 10-year period, which includes obviously pre-pandemic periods, we see that oil prices have actually declined pretty significantly, 23.5% over the last decade. Iron and steel has gone up about 42%, and asphalt paving mixes have gone up pretty substantially, especially, as I said recently, about 45% over the decade. Lumber, while it had spiked dramatically during COVID, it's back down to just above long-term pre-pandemic levels. So what kind of financial condition is the consumer in? Well, one measure we use for that is the percentage of disposable personal income that a person is saving. Or I should say saving as a percentage of their disposable income. And the long-term average savings rate is about 8.5%. And we can see that is down right now to about 3.8%. So as prices have been going up, people are spending they're spending more to meet that demand or that requirement, and their savings rate is going down. Also, the savings that many people had accumulated during the pandemic is being spent down. In this upper right-hand corner, we can see a chart in blue of the savings that's been declining as people are spending more. Finally, the amount of credit card debt and credit debt that people have has been increasing, still at reasonable rates relative to the long-term averages, but more debt and, of course, higher interest rates are resulting in higher payments for that higher rate of debt. The Fed has raised interest rates dramatically to try to get inflation down, and that has been working, although the rate of decline, in other words, the slowing of the pace of increases in costs, which is, of course, inflation, has been coming down, but now it's started to move sideways, and we're seeing it kind of tick up, tick down, tick up, tick down, and not continue to decline as much as it had been. So the result of that is that the Fed is likely to hold interest rates. Again, the central bank setting short-term interest rates, likely to hold those short-term rates higher for longer, which we would expect would continue to cause slowing in the economy. But the economy's been surprisingly resilient and has continued to hold up pretty well. So you can see the expectation for interest rates, and still interest rates are pretty significantly higher than they were even just a year ago, as you see that looking at the prime rate. So what's going on in the financial markets? Well, stocks have largely, if you look at large companies, and again, I would break that down. If we use the S&P 500 as a measure, we've seen substantial recovery in the S&P 500, but that is largely driven by just the top 6 or 8 companies, and a lot of that's driven by the boom in artificial intelligence. So we see Microsoft, Nvidia, Meta, or Facebook driving a lot of the gains that we're seeing in the S&P, and small companies, and in particular more small value companies like small and regional banks, are still struggling with a challenging environment. Real estate also has not recovered over the last year, and the bond market continues to be negative over the last 12 months. So it's a mixed bag in the investment markets, but we're keeping a close eye on it and making adjustments in our clients' portfolios. And if you'd like a review of your portfolio or to talk about your business and how we might be able to help, please reach out to us. We'd be happy to chat. Thanks.